The Goods and Services Tax Council cleared the air on a range of issues at its 52nd meeting held on 7th October. What has been hailed as a welcome move by the liquor industry, the Council decided against levying tax on extra neutral alcohol or ENA, specifically intended for consumption. Extra neutral alcohol is a raw material used in producing alcoholic beverages. The Council conceded the right to impose tax on ENA to the states, while tax on neutral alcohol intended for industry use will continue to attract an 18% GST. Additionally, the GST rate on molasses, which is a key ingredient in making liquors, was slashed to 5% from 28% earlier. These steps altogether brought much awaited tax relief to industry stakeholders, as the issue had been hanging fire for over 6 years since GST was enforced. Besides benefiting sugarcane farmers, the move will limit the possibility of a rise in liquor prices.
When you look at the discussion that happened in respect of ENA also, this spirit of cooperative federalism was very, very visible, because the central government was empowered by a decision of the Allahabad High Court. And if they had wanted, they could have put their foot down and they could have taxed the product. But in the camaraderie that prevailed over there, they were able to give the power to tax ENA for the purpose of alcoholic beverages to the states. And now the states will decide what they need to do. Each state can impose its respective level of tax. The tax rates among the states for ENA for alcoholic beverages may be uniform, may not be uniform. So that, to my mind, was a very key outcome, where for the first time they moved, the center and states moved in tandem with each other.
Further, the Council recommended zero tax for millet-based food preparation that contains at least 70% millets by weight when sold in loose form, while a 5% levy will apply if sold in pre-packaged and labelled forms. Experts say this could provide a fillip to PM Modi's push for millet consumption in light of 2023 being observed as a year of millets globally. The Council has also decided to impose 18% GST on corporate guarantees provided to related parties, on 1% of the amount guaranteed. Prateek Jain of PwC elaborates.
So there was an issue that when, let's say, a holding company gives a corporate guarantee on behalf of a subsidiary for which they don't charge any money, whether that was subject to GST or not, because it's a related party transaction. And even without consideration, it could be subjected to GST. They have clarified that in those situations, 1% of the guarantee amount would be taken as a consideration on which 18% GST will apply. Again, this will have a significant impact because corporate guarantees are issued in sectors such as power, construction, and so on, where there is no output GST liability very often. That means that whatever GST you pay, it could become a cost. So one hopes that this will be a prospective amendment and will not be taken as a retrospective.
Several states raised concerns about the allocation of revenue collected from the compensation cess after March 2026, which marks the deadline for repaying the loans taken by the centre to compensate states. The compensation cess was introduced to bridge the revenue shortfall that states experienced after the GST rollout. Finance Minister Nirmala Sitharaman later clarified that the GST Council has agreed to hold a discussion on the issue. Few states like Goa and Delhi raised concerns about retrospective taxation on e-gaming. The concerns resurfaced as tax notices to the tune of about 1 trillion rupees were issued to several gaming companies ahead of the new 28% levy from 1st October. The Council clarified that betting-based online gaming firms are already liable to pay 28% GST with no retrospective taxes imposed. While the gaming industry may not be happy with the Council's decision, the same wasn't the case with all taxpayers. The Council offered a breather to taxpayers filing appeals against demand orders issued by tax officers till March this year. It introduced an amnesty scheme by extending the time for filing the appeal till 31st January 2024.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.
She's working her way to the corner office. Business Standard.